What's going on, everybody? Michael Silva here. Welcome to another episode of the Stock Market Brief Show. We use technical analysis and intermarket analysis to get a good idea as to where the market might be headed next. Tomorrow we got the big CPI numbers. It's going to probably shake up the markets. The markets really haven't gone anywhere for quite some time. Yes, we did hit new highs, but it doesn't really actually feel like it because, well, we hit new highs, but we're still been relatively range bound for the most part. I got a lot to talk about. We're going to go over the indices. We're going to go over a couple of indicators. I'm going to go through bullish perspectives and bearish perspectives today, just to give you a good round view, right, of the overall markets. Think of a coin, right? Robert Kiyosaki often says a coin has three sides: heads, tails, and the edge. We like to sit on the edge so we can both look at the bull's perspective and also the bear's perspective here in the markets. Let's hop into today's show. All right, everybody, welcome back. Now, I want to go over a couple intermarket principles here that are interesting. Now, we're looking at oil, okay? Oil has been on a big move since pretty much April of 2020, okay? It's been rising rapidly. You can probably see it at the pump in most cases. It's getting pretty expensive, at least where I live. It's like $4.60 a gallon. Good thing I got a hybrid and I don't drive that frequently anymore, at least. Getting besides the point. But when oil prices start to accelerate to the upside and, cost more at the pump, that puts, a squeeze on consumers. And consumer spending, it accounts for a large percentage of the U.S. economy. So you typically see an inverse correlation here. When oil goes up, you can see retail, that's the red line. It's actually the relative performance. So I'm dividing retail, RLX, into the SPX. Okay, you can see that go down. Why? Well, retail, when oil prices go up, typically puts a squeeze on retail, and you can see that they underperform the S&P 500. You can see that here. It's heading down, oil's going up. And we're at a pretty key level here that I found interesting is oil was, it's been very choppy, right? You can look at the XLE and it's been kind of heading lower. It's been underperforming the SPY. Well, we're at an area of support, and today even, we actually saw a little bit of a bounce. This chart was, is this updated chart? No, I think I pulled this from my Twitter account that I posted on Twitter. Okay, so we bounced a little bit. And then also, if you look at the retail over SPY, this relative performance is also at a very key level of support here. My thought process here is if oil starts to bounce from this levels, I think we're going to continue to see weakness in the retail sector, right? Because if oil prices get more expensive, and this is just one aspect, keep in mind, rising oil costs also affect transports, right? At least the ones that their biggest expense is oil. And we've been seeing transports also going down south. We'll go over a chart of that here soon. But this is an interesting relative performance line to look at RLX over SPX or even the retail index, because it really does kind of do a good job on really telling us kind of the health of the economy. If I go a little bit deeper into it and I show you that over the RLX, you can see that the price action, the green of the RLX, the retail index, it's been going up. But you can also see that the price is rising, but the relative performance to the SPY, it's been going down. And what is very interesting here is this is something that actually happened before the financial crisis. Not to say that that's what's taking place here. This kind of stuff can get resolved. Stop worrying, okay? But if I just pull up a chart from 2003 to 2008, you can see here the red line gave us a couple year warning here. Right, from 2004-ish to, let's just call it mid-2005, it was putting in a lower high. Meanwhile, the RLX, the index itself, was continuing to press higher. And it wasn't until shortly after, after these warning signs, we start to see movements to the downside. Now, there are more warning signs out there that are very interesting that took place leading up to 2008 that are doing the same thing right now. Maybe I'll make a separate video for that. But I do find it interesting to kind of watch how the retail sector is doing for the reason that, like I said, consumer spending accounts for a large portion of the U.S. Okay, and this could get all adjusted. I just wanted to share that with you because I did find that interesting. Okay, so if oil prices continue to rise, I think it's going to put more pressure on retail, which could put more pressure on the economy because of consumer spending. All right, I'm carrying this on. We have the CPI numbers tomorrow, and I think a big thing that everyone's going to be focusing on is what the bond market does. The bond market has been rising rapidly, right? The 10-year has been lifting up, and the 30-year has been bumping up. And what does that benefit? Well, it's been benefiting financials. And who is it hurting? It's hurting tech, the big tech names, right? Another thing that we've been noticing is the dollar has been gaining some steam here. We're still below this area of resistance, and if this starts to break out, the dollar has been having an inverse correlation to the S&P 500. So if the dollar does break out, it could be a quote-unquote flight to safety, potentially, where we might see more pressure in the markets. Now, most of the S&P 500 today, even the Dow, it looked like what held the markets together today was really financials. Financials played a big part. As you can see, they were right there in the top 3 performing sectors, along with their energy and materials. Okay, so it's going to be interesting to see how the dollar reacts to the CPI print tomorrow, and also the yields. This could be just a blip. It could be just a little boop, and then we're going to fall back. We've seen that plenty of times where that happens. So we got to keep a close eye there on what the market, how it interprets that CPI data. And always be certain and be careful. Sometimes this is very algorithmic driven market. So when the numbers come out, you're going to see quick reactions most likely. But you need to let the price digest itself to really understand if we're seeing a shift in trend, right? A day, 2 days, that doesn't change a trend. And as you can see here, we've been trending lower really since March, mid-March. Okay, so we're seeing an uptick. Are we starting to break out and continue to ramp up higher? Are we is the market factoring in higher growth and inflation? I don't know. That's what it's been doing these past couple of days. But if we look back to March, that's not what it's doing, especially when you look at the curves flattening out. Let's look into some of the sectors. So XLF has been on a nice tear. It broke out of a trading range, and it's been just flat. So what can you do if you want to play financials? Well, really, we could see some crazy shakeups tomorrow. So like I said, you want to let time kind of settle. But the 5-day moving average, it's inclining. We have a gap here that can act as support. So we have that acting as support. We have the gap acting as support. Then we have a volume shelf profile here with price action acting as support. So if we do get a move down to 37.10 to fill this gap and act as prior resistance and right around the 5-day inclining moving average, that can act as a bounce level. So keep an eye on this little area right here to play financials. If it comes down there, right? If the yields all of a sudden start ripping to the upside, well, then you'll probably see financials start to head higher too. And they've been in a nice uptrend here these last 3 days of trading. It's kind of forming a pennant here, so we'll keep an eye on it. Let's keep going. XLK, forming a little bit of a bear flag. It's below the 5-day moving average. The 5-day moving average is starting to roll over here a little bit. So tomorrow is a very important day because we're going to see how the bond market responds to the CPI print. And if the yields go up, right, that's been putting pressure on tech. Tech hasn't really gone anywhere, to be honest. It's really flat. So I put it in this box. What could we potentially do? Well, if it breaks down this bear flag, this little bear pennant, look at the lower range right here. 151.25 in XLK. That can act as an area of support where you see a bounce. Okay? If it starts breaking, capturing control back of the 5-day moving average and breaking out of this 155 level, that looks pretty positive. And most likely, if that was the case and we start to see, the monsters of tech start to perform again, chances are we'll probably see the yield start to reverse itself. And when I say yield, Matt, you can look at the TNX, 10-year yield. XLE, energy. Energy hasn't gone really anywhere for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. 15 trading days. If you just look where the price action is now, 49.67, and you look to the left, it's right here. This could be good. This could be bad. Right now, it's just basing out. So it's hard to play this range. There are definitely strategies to play the range. I want to see this either break out to the upside, and then let's hit those buy signals, the buy button. But if it breaks down, then we got to just be mindful that the next level of support can be right here at around 46.50. Okay, so it's been range bound. Let's see what takes place. I think we're going to see a lot of movement tomorrow. It's been so flat leading up to this number. It's a very difficult environment to. Somebody on my Discord channel, if you're part of my Patreon group, they asked, why haven't you posted too many trade alerts? Well, I haven't posted any trade alerts really because I haven't been trading in this environment. There's been very, very few scalps that I've done, but I just don't like trading in this environment. I like to see more clarity. So that's really the only reason why. Semiconductors. Semiconductors saw some weakness today, and this is important to watch because semiconductors make up a big portion of the composite, the Nasdaq composite. And if we see continued weakness in semiconductors, that's not a good sign for the overall markets and the indices. However, if it does continue to break down, it could be a great sign to buy the dip because in the overall scheme of things, it is still in an uptrend. And here at about 257 to 258, that's a great area of support. You have a volume shelf profile right here, and you have previous resistance. Once resistance is broken, it then becomes support. And guess what? We're kind of forming a little bear pennant here. A full measured move breakdown of this would bring us to right around that 257. Buy. That's what I would do. At least, it makes for a good risk to reward. I would buy in at 257. I would have a stop loss probably under the 255 to 254 marker, and I would try to play that to play the upside. Now, keep in mind, you'd be buying price below a 5-day moving average, and it would probably be declining at that point. So you'd be risking a little bit there. You could technically wait to see if it gets back above this level of resistance and continue to press higher. That would also be good if you want to wait for confirmation. IBB. This is Biotech. Biotech's been a very, very strong performer. I wanted to map out a couple of levels here. You have the 5-day moving average inclining, bottom left to the top right of the screen. So it's trending up. That's a good sign. So this says, hey, yeah, let's look for dips to buy. What you can do if you want to be a little bit more accurate and time the market a little bit more effectively is you want to buy price when it's above the 5-day moving average, when it's also inclining. It helps with the trend. You have wind at your back at that point. So you could wait to see if it breaks above 175, enter in, and then have a tight stop loss. And then play and mitigate risk as time goes. Because it's in an overall uptrend, you can look for areas of support. And one area of support that I have my eye is set on is 167.50 because it acted as previous resistance here, right? And there's a nice volume shelf profile. Also to note that we have some support previously here right at around 170.50. So those are a couple of levels that you might be able to play a dip, all right? Let's look at IYT. This is transports, a transports ETF. It's been range bound, hasn't been going anywhere, but we are seeing some strength here. Today we saw some strength in some cyclical names. Where can you potentially buy a dip if you think it's going to continue to the upside? Look at the volume shelf profile right around 250.50 or 251. If we pull back into that area, that also lines up with the 5-day moving average, which, by the way, will probably start inclining here shortly as some of these days fall off. So keep an eye on that, but really we're still, look at the 5-day moving average, it's been declining. So you'd be buying at a low point, at a low print. In the short term, it's been bearish because it's been trending lower lows and lower highs. And you could see that here. So here's the TRAN, the transports, Dow Jones Transportation Average Index. And a couple interesting things took place today. Hello, peeking its head out. Is this a bear trap? Or bull trap, I should say, sorry? Maybe. But right now, that's so far a good sign. We're breaking out with a little bit more of an uptick in volume. We've had 3 days of an inclining volume, but the volume itself is, nothing out of the average, nothing out of the ordinary. What's important here, though, is we have a declining 50-day moving average, and that can act as a level of resistance. The Dow Jones right beneath, as you can see, hit an all-time high. We'll go into that chart separately, and that's a good sign. So that is strong to see. Hey, it didn't, like I said, it doesn't feel like we went to all-time highs, but we did today. So what we really need to see is a continuation of the transports to press higher, especially if we want to see the industrials continue to head higher. And like I said, also, industrials made a new high, not necessarily with all the help from the transports that did help, but financials did play its part in that move. XVG, the value line geometric index, has been diverging from the S&P 500. That is a flag that we want to pay attention to, a red flag. And we've been talking about this for now a month, maybe longer. But on a good note, we're right there at the range to potentially break this downsloping trend. And if we can do that, that's going to really, really, help with this move in the S&P 500. Because keep in mind, we've been so tied up in a tight channel. A gamma squeeze could very well likely happen where we see just some big volatility spikes, big movements in the S&P 500. Hasn't happened yet. Okay, perhaps tomorrow it's the day because of the CPI print. We'll see. It's very hard to determine. Got to follow price. S&P 500 equal weight broke out also once again to all-time highs as the S&P 500 did, not diverging. That is a great sign. You really want to see that take place. A lot of people have been giving me a hard time because I'm talking about that. This is a good sign. You want to see this in a bullish environment. Now, if it starts rolling itself back over, but the S&P 500 trucks higher, just be careful for that. Now, a couple warning signs that I have is this. VIX Volatility Index on the 30-minute time frame. Look at the Bollinger Bands, how tightly contracted they became today. It hasn't been that low since really July 12th. Now, from a seasonality perspective, mid-August to October, you typically see rises in volatility. And that puts pressure on the S&P 500. Something to watch, okay? Bollinger Bands, when they contract, they typically lead to an expansion. What does that look like? Well, we contracted here. It held there for a day and a half. And look what happened. It expanded. Boom. Okay? Right here, it did the same thing. It contracted. It actually gapped lower. And then, bam, expanded significantly to the upside. Okay? Doesn't mean that we're going to see a big, huge spike. If we do, I would be pay attention to 2050. Because that right there, if we get a big spike, that could be an area to start finding long positions in various S&P 500 stocks. On the weekly time frame too, this is obviously longer term. The Bollinger Bands are also contracting very tightly that we haven't seen for a few years. And this matches up with the seasonality script. So if we were to see the Bollinger Band squeeze where it contracts and then expands, that would match in with the seasonality of what we typically see in the VIX. And you can see here when it contracted this tightly, bam, to the upside, contracted, bam, to the upside, contracted. Not really that big of a bam, okay? Now let's hop into the indices. S&P 500, we're going to move a little bit quicker. Yes, tagged an all-time high. A lot of indecision rolling into the CPI print. Overall, very bullish context on the chart. 15-minute time frame. We broke out of this range, this channel. We're wedging. We haven't went anywhere since this breakout. So I am noticing a little bit of a little triangle here. So we'll see that the 5-day moving average is inclining. If it starts breaking back down within this channel, I would start looking at 436 probably as an area of support here. That would take a lot to get down there. I would say we'd also have some support right here at around 439.50 to 439. That would make sense if you look at the volume shelf profile. Okay. Dow Jones also all-time high today. Hello, industrials. This could be because of the infrastructure bill. That's we saw a lot of movement in the industrials because of that. I forgot to mention that. Everything's bullish. A bullish breakout. Transports are kind of moving up in the right direction. We saw some strength in financials, good volume on today's break. So we'll continue to monitor that. If it gets, if we get some sort of bull trap, then let's be a little bit more careful. But so far, so good. And then if we take a look here on the 15-minute time frame, we're above this volume shelf profile. That's a good sign. We're right there butting up to that area of resistance on this broadening wedge pattern. But the 5-day moving average is inclining. You could potentially call this an inverse head and shoulders. If we start breaking out, hey, that might be a really great thing to the DIA ETF. That's the Dow Jones Industrial Average. Let's look at the Nasdaq 100. Nasdaq 100 is flirting with this trend line. This is something to be careful with, right? Because like I said, tomorrow if the CPI print and the bond market reacts to where the yields start to rise, this probably breaks down to where? Well, we'd find support probably at the lower Bollinger Band to the 50-day moving average, and that's right around 14,500, plus or minus 100 right there. Okay, so keep an eye out for that as an area of support, an area of confluence of support for potentially a bounce and then potentially head higher. But just be mindful that that is very possible if we start to see the rate of change on the 10-year yield start to spike higher. If you look at the Qs is forming somewhat of a little bear pennant right here. And if it breaks down, that'd probably take us to the lower range, right around 362 to 360.50. So that'd be an area to watch to look for bounces. Okay. 5-day moving average, relatively flat. So, not much going on here. Like I said, we need a little bit more data. But I don't see a trade setup here at this particular point in time. Maybe perhaps if we don't get some crazy gap down or crazy gap up and we kind of open up around this area, you might be able to put on like a short if you think that the 10-year yield's going to rise, like a quick put little scalp, or just short it into an area of support. Be careful, because obviously tech has been, if you've been shorting tech, I mean, got your face ripped off. Let's go into the Russell. Russell has been range bound forever. I'm just kidding, not forever, but 5 or 6 months. It has been range bound, and we're still below these key moving averages. This is going to be very important to break above. Bollinger Bands are getting pretty tightly contracted too, so contraction leads to expansion. Let's see what takes place. Price percent oscillator, still under 0, but it is trending bullishly right here. If we get above 0, that'd be really good. A couple things to note is we had a kind of a rising wedge. We broke down through that, and now I put a light shaded line here to show that it's still within a potential bear flag pattern. If we break down from the bear flag, we can definitely start taking down the 200 moving average. But as it stands right now, we are just going sideways. Nothing changed. If financials continue to see this move to the upside, that's going to really help the Russell 2000, because there's a lot of financial stocks, right? The IWM, 20% of its holdings are made up of the financials. So that'd be a positive development to see. And then let's look at the 15-minute time frame finally here. I expanded the range. The range that I was watching was right here from around 221 to 217. Give or take a few. You can see the volume shelf, a lot of volume, just a lot of choppy action for quite some time now. If we start breaking above this little blue pattern pennant, whatever you want to call it, I think we can take out 224.50. We take out 224.50. There's still resistance. We have a gap up here above us. So far it's looking good, but really it's just range bound. So be very careful in these range bound environments. I wouldn't be surprised to get some sort of crazy gap up in the cash markets after, I think the CPI data comes out pre-market. I have to check when the data comes out, but just be mindful that we have support here at 217.50, 217 to 217.50, and then we have resistance still here at around, let's call it 225, and then also 226.50. Okay, so you can create trade plans around those areas. For example, if we start to head lower, or we get a big rubber band candle to the downside, and we're right here at around 217, you can take a long position there, and then you can just have a stop under a few bucks beneath it, and then that can make for a bounce to the upside. Okay, so I mean that's just an option. All right, that's all I got for you, everybody, on today's episode. Hope you all have a wonderful night, and I will see you back most likely tomorrow. If we get a big shakeup in the market, I'll probably do one tomorrow. All right, see you later.